Okay, hello and welcome. Today we're going to look at some yield curve trades. We're going to look at a couple of, a little bit of movement in the US Treasury yield curve. Well, a little bit, there's been a lot lately. I'm filming this within about 48 hours of the Fed's decision to hike rates. So we're going to look at how the yield curve moved heading into that and how the yield curve has moved since, and some potential trades which are applicable not to just now, or not so much now even, but more to how to trade volatility and how to trade what I'm just going to call loosely as hype. So we've all heard of the expression buy rumor, sell facts. So this is how to apply that when looking at yield curve, in particular hype regarding inflation and rate hikes and all those fun things. So anyway, let's get on with it. So this video was actually made for a couple of our new members at Masterclass Trader, but I'll put it on YouTube in case anyone else might be interested. We've been talking a little bit about and getting more into relative value and spreads and all of that kind of stuff. And when we look at the treasuries, we're talking about yield curve, of course. Now, if you're new to the yield curve, if you're new to trading treasury markets, first up, there's some specs there, and if that's not enough, then as always, go to the exchange website and look for a link that says specs or contract specifications. We generally call them specs in the futures markets now, and that'll give you all the details about each individual contract. What I've got here is what I think is a confusing display for the yield curve. I've got, if we just look at the top three and the bottom two, I've got the 5-year note, 10-year note, or the T-note I should call it. I'll explain why we shouldn't call it a 10-year note in a second. We've got the Ultra 10s, relatively new contract. We've got the T-bond, and we've got the Ultra bond, relatively new contract also. And that makes up essentially a yield curve. If you haven't seen a yield curve before, it looks a little bit like this. A yield curve displays term to maturity along the bottom, and the axis shows the current interest rate. So a yield curve essentially shows in a way, it shows the state of the current economy. Not only what interest rates are, but what interest rates are over the longer term, or the market values them at. What they call a normal yield curve, you can see, if you have a look at the yellow line, that's where the yield curve was a month ago. Now, this is a yield curve, by the way, based on the futures contract, September futures contract. So I've got, in terms of the fives, the T note, the Ultra note, the T bond, and the Ultra bond. I do want to point out before I'll come back to this in a second. Let's get rid of that. If you see the second line there, or the third line down where it says in years, that shows the current maturity for each of those securities. So a 5-year note is actually, right now, it's a 4.5-year note. A T note, what we used to call the 10-year note, or the 10s or whatever, is actually a 6.9-year note. The Ultra note, which is a contract that was introduced to have a maturity closer to 10 years, is 9.9 years. The T-bond, which we used to call the 30-year bond, is actually 15.7 years, and the Ultra bond is close to 26. Now, these things change over time because the US Treasuries are based on a physical security. They're delivered at the end of the futures contract. They are deliverable as opposed to cash settled, like something such as the E-mini. So there is an underlying security, what they do call the cheapest to deliver, CTD. If you look up on the CME website, and if you Google CME Treasury Analytics, you'll see a page that shows some of the details for what's called the CTD security. And that is essentially the physical treasury that those futures markets track. So currently, as I said, I just read out the maturity for those years. What we used to call the 10-year note is actually tracking a security with 6.9 years to maturity. So that's important. That sounds boring. That sounds like an actuarial thing. It's not. It's something that we need to know when looking at yield curve and understanding the dynamics of how these things move together. We're looking at things such as spread trades, and I have a couple of little bits about spread trades in that little scrolling thing up above. When we're looking at spread trades, we need to understand how these things move together, what's normal, what's abnormal, how it should move under certain conditions. And part of that understanding comes from understanding what it is we're actually trading. Know your market, as they say, and as was drilled into me many years ago, know your market. But if we go back to this yield curve. Now, this move, I won't say it's unprecedented, but it's exceptionally large for the yield curve. Yield curve tends to move in a bit more of a steady, secure kind of way, but we do see a little bit of that kind of nice, gentlemanly move in the yield curve, even just here, and even just from one day's move. But right now, it's a really good example of how things can play out over time. Quite often, you'll see these kind of drawings in economics textbooks, and they'll be years apart. But this is, a month apart from the two extremes. So if we again take a look at that yellow one, that shows what's called a normal yield curve: low rates at the front, higher rates at the long end, and somewhere in between for what they call the belly or the middle of the curve. Now, what has happened is that the market has shot up. The expectations of rate hikes have progressively increased. And if you remember, even just a couple of days ago, everyone was talking about a 75-point hike. What tends to happen with the yield curve is that it'll be priced more into the short end than the long end. If you think about the long end, like the T bond and the ultra bond, a 15-year security and a 26-year security, if you think about those as more the long-term average of interest rates, it's one way to think about it. You'll find that when a yield curve moves, it moves a bit like a dog's tail. So there's one end that doesn't move very much, and there's one end that moves about a lot. So that's the same as the yield curve. So when things like ridiculous news headlines and all the hype that comes along with these, dramatic market events, when all that happens, you'll see the bigger volatility play out in the long end. And that's where, getting back to here, it's very hard to see. Yes, you can see volatility in this, but it's very hard to see the relative movement because of the way these things are priced. They're not priced in terms of yield, they're priced in terms of price. I knew that. But when we look at a yield curve, when we look at that display in yield, we can see the relative change. So you can see that ultra bond and that T bond not moving as much as that shorter end of the curve. And that's what happens when markets are hyped up. So I do want to look at a couple of trades here. There's nothing else I need to cover there. Let's get rid of that one. Now, this is a very I drew this up and then thought, geez, this looks bloody complicated. So I put a black line in between the sections. Let's just focus on one thing at a time, and we'll kind of work out our trades and a few terms and things here. Now, generally speaking, you can argue that the best trade to make during times of volatility is just to kind of go with it, as in, do spreads come into play? Not particularly. You could easily argue that. Thinking of this kind of reminds me of, there's a video on YouTube, a little documentary about the Sydney Futures Exchange. It's quite old. I think it's about 20 years old or something like that. And they're interviewing a guy there called Rambo, as a former floor trader, a bank bill trader, I believe, mostly, I think, and a bit of a kind of larger than life character. And he said something so bang on when it comes to trading this stuff. And I'm paraphrasing, but he said something like, we spend our life just trying to, our job is just to grab that comet and just ride the tail of the comet for as much as we can. And when you see markets trading like this, you kind of think of that, there's the comet, and as much as you can grab of that, then great. Now, it's volatility like this, even a good day and your P&L, that makes a prop trader's month or even quarter. I've seen this stuff happen quite a lot. You can plod along for a while and really only make your money in one day. And you kind of think, well, why did I even turn up the rest of the month? But you still have to anyway. But getting back to these kind of trades, so trading directionally when the market is full of that hype, like how much will the Fed hike rates and all that stuff, is at the aggressive end of the scale. It's also can be very hard to pick. It can be very hit and miss. I've been there, and I've taken taken good money out of the market in trading like this, but also been hit at the same time. In fact, it can go up and down. Your fortunes can rise and fall over the course of the day very easily and very quickly. So that type of directional trading is very hard, or it can be very hard or very risky. And that's where we start to look at spreads. And spreads can have much lower volatility, but also much more what I like to think of as forgivability, a bit more, if that's a word, but more forgivable. So when you get things wrong, the timing doesn't need to be exactly 100% because the spreads will kind of behave a bit more sensibly. And that does play out even in times of volatility like we have now. Let me have a look at, if we have a look at, I want to focus more on what I'm going to call the hype off trades. It's I'm inventing these terms. It's a bit similar to the buy rumor, sell fact kind of thing, which is more an equities trading term. But if we think of the hype on as a period of when all those big news headlines are coming out, and when you've got your head of bond markets at JP Morgan's or whatever saying, well, you think the Fed's going to do this, and there's all these. I've got I don't have it here. I used to have it here. I used to have Bloomberg TV sitting there. I've got it in the next two rooms. I like having it on, but not while I'm working because it's distracting. But leading into this Fed meeting, there were so many people getting up there with their suit and tie and stuff, and head of whatever dealing room or whatever, saying we think the Fed's going to raise by 75 points. The next person said, oh, they're only going to be 50, and then the next person said, no, it's going to be 100, and all of that. Now that's just what happens in the nature of markets. It's just what happens with expectations, and it's certainly what news services will grab onto and highlight and all of that kind of stuff. And that's the hype. That's the hype leading into this stuff. And if you look back at what's happened, those big three red candles leading into the Fed move, then that's exactly what it is. That's hype, right? So again, trading directionally is tricky with that, but you can see how. Let's see. I'll show you how that move played out on the yield curve. All right, so if we look at what's happened, say a week ago, the yield curve was almost flat, and that hype, that three, where are we again? Let's find it again. Those three bars there, that's the blue line is the aftermath of that. That is, you can see how the curve has gone from normal to flat to inverted, and that's that hype trade. Trading that, again, as I said, is going to be quite difficult. But the idea is, of course, your direction wants to be in the short end. So, as I said, because the short end, the short-term interest rates tend to move faster. So you want to be where if you're looking for rates increasing, you're going to be short the short end, and longer the long end. I've put down in the table here short the fives and long either the T note or the ultra note. I haven't put the T note, the T note in there because of that shorter maturity. So that's where that thing comes back. Let me go back to that slide. 6.9 years maturity on the T note. So when you're looking at a spread, you're not really spreading much out when you're trading the fives versus the T note at the moment. So there we go. So I've said with this particular trade, we might look at being short the short end and longer the ultra note and the T bond to make a nice little trade. You could do it in the ultra bond too. There's one thing you really do have to pay attention to, and I've covered this. I've got a podcast on treasuries. I recommend you listen to it. I'll put a link below for it. But we talk about measuring volatility in each of these instruments. And we do that in interest rates with a thing called the DV01 or BPV, they call it outside of America. Now that just essentially just measures, what it means is, I've got it at the bottom of the table here, it's just the dollar value of a basis point move. In the fives, it's only a $44 move. 1 basis point is $44. In the ultra bond, it's $260. So if you were trading spreads, and this is another thing you often see. You often see when they talk about spreads, the most common one would be what they call the NOB, N-O-B, notes over bonds, which is the T note versus the T bond. That's a very popular trade, but fives are quite popular. It's part of a spread as well, but you often see it one versus one, price minus price. Now that is just the incorrect way of doing it, and in my opinion, completely pointless. There's absolutely no point of even looking at that trade because, as I've shown here, one is more volatile than the other. It's always going to be that case because of the different maturity levels. Okay. So what we need to do is adjust with what some call a spread ratio or a hedge ratio or whatever it is, a volatility based ratio, if you like. We need to adjust what we trade, how much we trade of each one to create an equal hedge. So that's kind of factored into when we look at a yield curve, when we look at this one here, that's kind of factored into that because we're comparing like with like. We're comparing yield. The axis there has percentage points, not price points. So that's all factored in when we look at that kind of stuff. But when we actually go to trade it, we need to do that adjustment. So the very last line there says 5 ratios. That shows how many of whatever security you need to trade to match the 5s. So if we're trading, say, the Ultra Note versus the 5s, we'd be trading 2.45s, 2.45-year notes versus one Ultra Note to roughly equate that volatility. You can do the same calculation with something like an average true range or standard deviation. It'll get you to a very similar point, not exact. But then again, there is no exact way of doing it. Argue with me if you like, but I don't think, it is a bit of a touchy feel when it comes to spread ratios. Not when it comes to margins, but that's a different conversation. But just when it comes to market exposure and so on, it is a bit of a touchy feel. And that's where I've got, that takes me back to here where I've written what overweight. Now, what that means is once we work out our spread ratios, let's say it's a 5 versus an Ultra Note, we look at a 2.4 to 1 ratio. When wanting to take a bit more direction, you can, of course, adjust that ratio to your liking. The reason I like the 5s is that it makes it very easy to do because it's a smaller tick, it's a smaller dollar value per move. So it makes it very easy to adjust those things. And if we're trading, let's say we're trading 5 lots in the Ultra Note, it means we're trading 24 lots in the 5. You can easily adjust to 23 or 27 or 19 or whatever. And that is something you tend to do when you want to take a bit more of a directional trade, but not be so cowboyish with an outright directional trade. The reason that's pushed me towards doing a little video like this for a couple of our members is I really want to talk about how the markets behave in what we might call the hype off or sell fact phase. So you can see here, let's go back to that yield curve, that one there. You can see here that move from a month ago, the yellow yield curve up to the orange yield curve, which was a month ago to yesterday, is quite extreme. It's pretty obvious what's happened. The shorts, short end rates have jumped a whole lot. The long end rates have jumped, but not by the same amount, and it's changed the shape of the curve. It's gone from normal to inverted, and by quite a lot. But I think what's really interesting is when you get to that point where it's past the buy rumor stage and it's now into the facts have been released and the Fed did hike rates. Now what happens? If you think of it like this, it's now the 17th, heading into the start of the US trading session on the 17th, so middle of the month. For the hype to continue, we'd have to have more things in the news to push the market, right? Think about that. Sure, we could have Fed officials coming out and saying this and that and the other, but in terms of data releases, generally speaking, in any country, you'll see the data releases come out most towards the start of the month, like payrolls, first Friday, for example. So you've got the second part of the month, which is relatively quiet relative to the first part of the month, which is now we're starting the second half of the month. So there's less risk for hype to keep. Hype needs to be fueled by more hype for these moves to keep happening. So if we wanted to see an even more inverted yield curve, it'd have to be fueled by more hype. I'm not making a prediction here, but it's just generally the way things happen. So what's even happened over the last day, for example, is things have kind of settled down. We've had our hike, and now we've got, a bit of a wait to the next Fed meeting. Of course, they can hike, the next day if they want to, but that's not expected so much. So what's happened in the last day, for example, we've gone from the blue line on that yield curve shows what's happened in the last day. You can see more or less a kind of parallel shift. It's not really. Um, there's been a bit more of the move in the short end, just like how the short end moves up higher. Rates move faster in the short end when we have a high bond situation. When things start to settle down, we'll see that start to kind of cool down as well. So you'll see a bit more of a move again in the short end. So if we go back to that little table where I've got a couple of potential trades, if we look down here at the hype-off spreads, again, trading directionally can be risky. It can be almost as risky as trading during the hype because things can get a little bit, stops can go off and this can go off and all of that stuff. And it can get a little bit too risky. Again, this is where spreads come into play, and there's some good moves in spreads and worth looking at. This type of spread right now, you'd be looking more to be long the short end, short the middle to the belly to the long end, and then adjust your ratios, of course, in the short end. Again, so same as the high bond trades. So the idea with this kind of trade would be, in fact, I've seen it play out here a little bit already. I don't know if you can see that on your screen, but you can see that this the yield over the last day. In fact, we've probably got it up here. The yield over the last day has moved, there you go, 14 points, whereas in the T-bond, it's moved only 7. So that you can see that things cooling down, and you can see where the spread trades are. I think that's this kind of scenario in the market really highlights one of the really good reasons to trade spreads is that, trading this kind of stuff can be really risky and be very dependent on getting your timing just right. But trading these kind of spreads, it gives you a bit more of a little bit more flexibility in terms of your timing. You're not going to make as much money, trading about the same type of contracts. It's a less volatile way of trading, but that works on the downside as much as it works on the upside. So there you go. This is kind of how that hype off trade will look like on the yield curve. So what would generally happen is, what I've just explained there. You can see that the yield on the short end has moved just that little bit more than the yield on the middle. If that looks boring to you, keep in mind scale, because right now, the last month, this scale, the markets have moved quite a lot. In normal times, that difference in movement is very significant, and certainly enough to make a decent amount off should you be on the right side of that trade. And so, like I said, well, that's just the movement from one day as well. So again, we've got the second half of the month ahead of us where there's less risk of more hypey kind of stuff coming out. So therefore, it feels like if you think of it from the point of view of the path of least resistance in this kind of trade, so you tend to see, or highly likely, or seems more likely to see that yield curve getting back to, not necessarily saying it's going to go back to where it was a month ago at all. It's not going to do that, but things will kind of ease off a little bit, and the value is in that spread trade in being long the fives and short the middle and the long end of the curve, if that makes sense. Anyway, quick summary from all of that. As I said, directional trades can be highly risky, and that's when we look at yield curve trades. We look at spread trades for these kind of things. It dilutes your risk, but it also allows you a bit better flexibility in your timing. And things are, I don't want to say a bit more predictable, but they kind of are. These moves are, we don't know where, the exact rates are going to stop if you like, but we have a better gauge on how the relative trades are going to play out, and that's why we get into these yield curve trades. As I mentioned, you can adjust your volatility in these things to suit your direction. I know I've kind of gone across these things pretty quickly, but that's what the subjects of other videos can be about. We can get into each point in a deeper way or whatever. But and you can also, I disable comments below in this YouTube thing because I don't like them. But you can contact me through my website as well. I'm happy to have a chat about this kind of stuff. But I think in these scenarios, keep an eye out on how these things trade. This data, by the way, for the yield curve stuff, not that one, this one here, all this stuff is straight off the CME site. They have a little section. If you Google CME Group and Google Treasury Analytics, there'll be a page similar to all that shows that data, that shows futures yield curve. So that's where you can watch that kind of thing, and it's free. So it doesn't need to be necessarily on your platform. As I said, contact me if you need more technical kind of questions. Anyway, good luck out there in the market.